my fellow freedom builders, here to Building Freedom. Today we're going to touch on a very important topic if you want to succeed with investing. We're going to touch on a formula, a mathematical formula that can pretty much guarantee your success in the stock market. Does that sound a bit clickbaity? Yeah, well, I guess it is, but I can guarantee you this, that if you follow my directions today or to the end of the video, I am going to show you how to use a little formula that not many investors know about, so that you know exactly what to expect every time you place a bet or an investment in the stock market. So if you're interested, follow me to the whiteboard here. So what we're going to talk about today is something called expected value, or EV. You often hear when you talk to seasoned investors, they are saying something like, you need to have an edge in the stock market. And everybody nods and smiles and say, oh yes, we need an edge. But what is an edge? Well, if you ask them, they say something like, that is an advantage. That is something that makes sure that you can make money. But that doesn't make you much wiser, does it? No, we have to have a formula. And that formula we get here from expected value. Because expected value, it kind of says it is what you can expect to get back in value every time you place a bet in the stock market or anywhere else. It could be in a casino, playing poker, investing in stocks, trading forex, crowd lending, whatever we're talking about here. This one can give you a lot of insight into your investments. So let's look at it. To start out this little explanation, and don't get afraid of the math, because it's not that complicated. And I am going to give you a little gift at the end of the video that I have here on my computer. I'm going to show you a bit here in the end, and I am going to give you a little Excel spreadsheet so that you can do it all by yourself at home. But what we're going to look at here is a roulette table. I suppose you know this one from a movie, or you've been to a casino or something like this. We know that on a roulette table we have the numbers from 1 to 36, and then of course we have this green number in top, a little 0 in a green area. Some casinos even might have a double 0, but let's just erase that now not to confuse you. So we have the numbers from 1 to 36 and we have a 0. Right now, in the beginning, let's just forget about this 0 as well and just look at the numbers from 1 to 36. As you might know, they are divided into two areas, a red and a black area. So we have half of the numbers are in red areas and half of them are in black areas. Meaning that at the roulette table, I can bet money on if it is going to be a red number or a black number. There are 18 red and 18 blacks, meaning that we have a 50-50 chance of getting it right here. So we have 50% and 50% here. Alright, this is what we need in the beginning here. Let's just have a look at the numbers. If I were to place 1,000 bets of $10 each at the roulette table. Give me a second and I'll get back with a clean whiteboard. Alright, I'm back again. Let's say, as I mentioned before, that we're going to make 1,000 bets altogether. And we know that we're just going to place a bet on red every time. So in theory, after placing 1,000 bets, we will have 500 wins and 500 losses. Meaning that we have 500 times $10, because we're making $10 every time we win. That is $5,000. We also have 500 losses where we lose $10, meaning that we have minus $5,000 from the losses. Now we take our profits and remove our losses and we are ending up with a big round 0, meaning that if we are placing bets on a roulette table and we are only having this red and black scenario with a 50-50 chance, and we are placing the same amount every time, losing the same amount every time, we end up with nothing because we have an expected value of $0, meaning that if we played enough times, if we were betting enough times, we would also always end up with $0 in profit. Now, the casino needs to make money, so they are actually playing on this expected value. Now let's have a look at how they're doing it. Because as I mentioned, there are one number extra, meaning that now the numbers from 1 to 36, and then there is a green area called 0. And every time the little ball hits the 0 and ends there, well, then the casino takes all the money. Meaning that now you don't have a 50-50 chance, you have a bit of worse odds. Meaning that we're still placing, maybe not 1,000 here, but we are placing our bets on the casino, and let's just say that we are placing 37 bets, and that is one for each of the numbers and the 0. In theory, if this was the perfect theoretical casino play, we would end up with 18 wins every time we placed a bet on the red, and we would end with 18 losses from every time we placed on the red but it ended up in the black, plus one loss here, meaning that we actually have 19 losses. So now we have 18 times $10 profits, giving us $180 in profit. But we are having 19 losses times a loss of $10, so we are minus $190, ending up with minus $10. Okay, so after 37 plays of $10 each, we will end up with minus $10 altogether. Now, we have to divide the loss, the overall loss, with the numbers of plays here. So minus 10 divided by 37 gives approximately 30 cents. Alright, that means that every single time you place a $10 bet at the roulette table at the casino, you are theoretically losing 30 cents. That is why the casino are interested in you staying there as long as possible. So that the casino owner, he doesn't really care if you're walking away with $1,000 or $5,000 one night or playing at the casino, because you know that if you have had 500 people in there placing 100 bets with $10 each, he will, for every single bet, in theory, have made 30 cents. And you, all of the customers, will have lost 30 cents. So what we have here is a negative expected value for the players, because they can expect to take a little loss every single time they place a bet. Of course, they are never actually winning or losing 30 cents. That is an average. And that is what we can use when we are investing in the stock market. So let's have a look at how this can relate to the stock market. Let's just clean this one out, and let's just pretend that you over an entire calendar year have had 200, let's say we hopefully end up with a positive expected value here, we end up with 200 stock trades altogether over a year. Let's just say that you're quite an active trader. Let's also say that you have a win rate of 60%, meaning that on average you win 6 out of every 10 stock trades that you're making. That leaves us with, after a year, 60% of 200, meaning that you have had 200 wins and 80 losses. Okay. Let's say now that every time you win, you make $100. We can write that one here. $100. And every time you lose $80. Now we have a scenario where you have taken 200 trades, you have won 120, you have lost the 80, and every time you have won $100, and every time you've lost, you have lost 80. Now, this is some simple calculations here saying that we will have won our profits from the winning trades. 120 times $100 equals $12,000 in profit. But we have also lost some money. We have lost 80 times minus 80, giving us a minus of $6,400 over the year, and therefore we end up with $5,600 altogether in the positive after a year. So we have a profit of 5,600. Now, if we divide that with the 200 trades, we end up with a positive expected value of $28 on average for every single trade you have taken over the year. I know that as well in the casino where we didn't make or lose 30 cents, you're probably not making exactly $28 on any of your trades over the year. But what this can help you to understand is that every time you're looking at your screen and you're having a strategy or a rules-based method that you use to your investing, you know that every time you see a buy set up on your screen, you need to take it. Because every time you push the buy button and you follow your rules, you're making $28 on average. There might of course be 10 or 20 losers in a row, but on average, if your statistics are valid, then you're making money every time you push the buy button. And that means when you're sitting and you have the perfect setup, it could be a technical analysis trade with some moving averages and a good technical formation. It could be maybe combined with some fundamentals where you like the numbers, the earnings per share, or whatever you're looking at in this company. And you say, I have the perfect setup. I can see that every time I take a setup like this, 200 times in a row, I'm making $28. But then you open up some financial website and some analysis from some bank says, well, this company might not be doing so well the next year. We have some concerns. And all of a sudden you get scared and you think, oh no, he's much smarter than I am. But that is where your numbers should come in. Because if you trust your numbers, then you take the buy trade every single time. It might end up as a loss, but as long as you have followed your rules, you know that on average you will end up making a profit. Alright, that is the exact same a poker player is doing, a professional poker player. They are working with expected value so that they know how much can I expect it to win from this hand with this amount of money on the table. It is the exact same thing you should do if you are investing in crowd lending and you're saying a certain number of my investments end up losing money. You can put it into this formula as well. And let me just show you, because I have an Excel spreadsheet as I mentioned. It's just a simple little thing that I have made for you. And let me just show you on my laptop, and I will link it to you beneath the video here. I'll try to put it into Dropbox and give you a Dropbox link you can download it from. But let me just show it here. Just give me a second. Alright, here we are at the laptop. As you can see, I put together this very simple little spreadsheet. I'm sure someone could make it even smarter and more fancy and with a lot more information. But here we have exactly what we need to calculate our expected value. Here you can see I've just put in $100,000. These 5 areas are the areas you could put new numbers into. All of the rest just leave that alone. But we have $100,000 and we are saying that every time we put on a trade we risk 2% of our capital, meaning $2,000. So every time we have a losing trade, we'll be losing $2,000. Let's just say that our win rate is 50%. We'll write that as 0.5 here. And let's say that our winners are 2.5 times the size of our losers, meaning that if you win or lose $1,000 when you lose, you'll be winning 2,500 when you win. So we have 2.5 times the size when we win. Number of trades, I've just put 200 trades in here. And of course, if I change this to 300, you can see that all of the numbers here are changing. So right now, let's just have 200 trades. You can see that with a win rate of 50%, we will be winning 100 trades and losing 100 trades. We also know that when we lose, we'll lose $2,000. That's what we put in here. And we know that when we win, our win will be 2.5 times our loss. That is what we have here. So from 100 trades with $5,000 wins, we will profit 500,000. And from 100 trades with $2,000 loss, we will lose 200,000. That is altogether a profit of $300,000. Now 300,000 divided by 200 trades gives us a number, an expected value, and here you can see it's green because it is above zero, but we have an expected value of $1,500, so that every single time you put money into the stock market, you can mentally prepare yourself to make $1,500. And you can try and play around with the numbers. Now, what if for instance it was in 2008 and you're back testing your method and you can see, well, in 2008 you were only making money 3 out of 10 times, and your winners were actually only 2 times your losers. Well, then you can see that you in 2008 were only winning 60 times, where you won $4,000, meaning that is 240,000, and your losses, that is 140 losses, losing $2,000. That is actually a bit bigger than what your wins were, and meaning that you were losing $40,000 or $200 per trade. But then you take the statistics from 2009 and you can say, well, because it went so well in 2009, you were winning 70% of your trades and your winners were 3 times your losers, and all of a sudden you can see that in 2009 you were winning on average $3,600 every time you placed a bet. Alright, back to the whiteboard here. Good. Now what can this give us? It's a lot of numbers and I hope they make some sort of sense to you. What this builds on, of course, is you having some good statistics. And of course you can take out from all brokers today, you can just take a list of your historic trades, and maybe you end up with 500 trades over a number of years. Can you use that number for something? Of course you can calculate how much do I win, how much do I lose, and so on. But the only way you can actually use these numbers is that you are using a consistent rules-based strategy. Because if every time you make a trade, it's kind of a mix between something you read on Facebook and your own gut feeling and what your aunt told you and what your horoscope set for a given day or whatever you're placing your bets upon, well, if there's no consistent rules and strategy and tactic that can be tested, then you cannot use these numbers for anything. Because you might be winning at one point, but if you don't know exactly what you did to win, you cannot copy it to the next trade. So you need a strategy, and that's some of the things I will teach you in this channel. I'll teach you my strategy and you can build upon that or change it or modify it however you want to. But you need a rules-based strategy so that you can open your computer one morning and see a certain chart pattern or a certain fundamental setup and saying, hey, this is a buy setup, and I know that because I have back tested this strategy for the last 10 years through a recession and a stock market crash and a downturn and an upturn, and I've tested it in a lot of different scenarios, and I know that I have a positive expected value every single time I place my bet. If you have that and if you know the number, then you're getting extremely much more confident every time you're placing a bet. And you can place it and you can go to sleep because you know that the law of big numbers are in your favor. You know that for the last 1,000 trades, this has been the case, so why shouldn't it be onward? Of course, stock markets can change and there can be some changes, but overall, if you have enough trades, like 500 or 1,000 trades over enough different market conditions, you can be pretty certain that this will keep going on in the future as well. So the positive expected value, or the formula for expected value, is one that you need to have. You need to calculate it. And if you are a beginner, you need to steal or copy or buy a strategy from somewhere that is thoroughly back tested. Just to mention this, buying strategies with a back test from the internet, I would not recommend it. That's just a little disclaimer here, because that is often back tested in a way that of course shows profit, because they want you to buy the system. So preferably you should get it from somewhere, someone you trust that have been using this for a while and can say, here are my numbers if you're new to this. Or you should have some rules that are easily tested back in time, so that you can take your computer and scroll it back 10 years on the chart and start testing it manually. Or you can get someone with a computer to build a back testing scenario for you. There are a lot of different scenarios here, and I will get back to them in future videos. But just to say, if you're a beginner, you can do this as well. If you somehow get hold of a method or strategy that have been working for a lot of years, like mine for instance, I have been using mine for a number of years. So get hold of a strategy or a method and test it and get your positive expected value, hopefully. Then you have a lot more confidence every time you invest. All right. I will link to this Excel spreadsheet as a Dropbox link just beneath here. If you haven't done already, and if you like the material I'm giving you, please like the channel, subscribe to it, like the video with the thumbs up, and hit that little bell notification so that you will get notified every time I put on some new content. That is 2 to 3 times every single week. All right, thanks for now. Take care of your money out there. I'll talk to you soon. Bye for now.